everything. Your mortgage rate and your house price, your job prospects, your stock portfolio, even the price of Bitcoin. It's all connected to this $100 trillion market that controls your life. And this is the bond market. If you don't understand it, you're basically swimming in the ocean with your eyes closed, completely blind to the financial tsunami that's about to wipe you out. If you finally want to open your eyes, decode bonds, and understand why ignoring this market is financial suicide, then let's dive in. Most people think bonds are just some boring investment for old people. Wrong. It's literally an IOU from the government. Bond market is also referred as debt market because that's exactly what you're buying. A debt. Think about it. When the US government runs out of money, which happens a lot, they can't just ask mom and dad for a loan. Instead, they sell you a piece of paper that says, hey, lend us $1,000 and we'll pay you back with interest. That interest is cost of using someone else's money. The money in your bank account is literally becoming less valuable while you sleep. A dollar today beats a dollar tomorrow every single time. Why? Because that dollar today can jump on opportunities right now. The next stock surge, crypto pump, real estate deal. But a dollar tomorrow, it missed the boat. That's exactly why people charge interest when they lend money. They're getting paid for all the opportunities they're giving up. While their money sits in your pocket, it could have been making them rich in the stock market or their own business. Time literally equals money, and every day you wait is money left on the table. And get this. Currently, the US debt to GDP ratio is 123%. That means America owes more money than it even makes in a year. Here's something that'll blow your mind. If you stacked $1 bills equal to just the US national debt, it would reach the moon and back 8 times. And if you paid off $1 million every single hour, 24/7, without stopping, it would take you 3,800 years to clear the debt. So here's the million-dollar question. If America is basically broke, why would their bonds still be considered the safest? Because almost every transaction in the world involves US dollars. Oil, traded in dollars. International business, dollars. A country wants to buy something from another country? They probably need dollars. This creates insane demand for the dollar, and since the Federal Reserve can literally print infinite dollars, well, in theory, the US can never truly go bankrupt. They can always just print more money to pay you back. Now, you might be thinking, okay, cool, but how does this affect my daily life? But let me break down exactly why this should matter to you right now. First, here's the brutal truth about how your government gets money and why they still go broke. The US government takes 54% from your income taxes, 30% from payroll taxes, 9% from corporations, and the rest from fees and fines. And even after taking over half of everything, they still spend more than they have. Defense, healthcare, Social Security, it adds up fast. They're like that friend who makes good money but always needs to borrow more. That's where bonds come in. The national debt? It's just decades of the government saying, we'll pay you back later, and selling you IOUs to cover the difference. So governments can't just show up at your house like, hey, can we borrow $1 trillion? Instead, the US Treasury runs these crazy auctions where they're basically selling debt to the highest bidder. Banks, pension funds, entire countries, they all show up throwing money at the government like it's a Black Friday sale. It's like an IPO, except instead of buying a piece of a company, you're buying a piece of America's debt. And when you hear China owns 1.1 trillion of US debt, this is how they got it. They literally outbid everyone else at these auctions. Here's the insane part. There's always a bidding war for US bonds. The whole world is literally fighting to lend America money, even though we're $34 trillion in debt. Why? Because somehow US debt is still seen as the safest investment on Earth. But other countries? Good luck. When they try to borrow money, nobody shows up, so they have to offer crazy high interest rates just to get attention. Okay, you get the main idea. Now, let's learn Bonds 101. Wall Street nerds love using fancy words to sound smart, but I'm going to break down their secret code in plain English. Principal or face value, the amount you're lending. Buy a $1,000 bond, aka debt, that's your principal. But the purchase price is what you actually pay for the bond, which can be different from the face value depending on the demand. Coupon, your interest payment. A 5% coupon on that $1,000 bond means you get $50 every year until maturity. Now maturity is when they give you your money back. Yield, your real return. And this is where it gets spicy. Here's an example that'll make this click. You buy a $1,000 bond with a $50 coupon. That's a 5% yield, right? But what if nobody wants the bond and you can buy it for only $900? You still get that same $50 payment, but now it's 5.55% yield because you paid less for it. This is the key insight. Price and yield move in opposite directions. But why do purchasing prices change? It's all about competition. Imagine you're selling a car that gets 20 miles per gallon. Then Tesla drops a new model that gets 40 miles per gallon for the same price. Your car just became a lot less attractive, right? Same thing with bonds. If new bonds are paying 6% and you're stuck with an old 3% bond, nobody really wants it anymore. The price drops until it becomes competitive again. But here's where it gets interesting. Flip the script. What if new bonds only pay 2% and you're sitting on a 5% bond? Suddenly, you're holding something valuable. People will pay more than you originally paid for it. This is the seesaw that moves the entire financial world. Understand this concept and you'll think like the smart money. Miss it, and you'll always wonder why your investments seem to work against you. Now you're probably wondering, who decides these interest rates that affect everything from your mortgage to your portfolio? It's actually a three-way dynamic between major forces. Treasury auctions. Think of this as the government's initial sale. The Treasury holds regular auctions where they sell brand new bonds directly to investors. Banks, countries, pension funds. High demand? Yields stay low. Low demand? They have to offer higher yields to get anyone interested. This is called the primary market because it's where bonds are born. The secondary market. Once those bonds are sold, they don't just sit there. Investors trade them back and forth like stocks. That's the secondary market. If you bought a bond and want to sell it before it matures, this is where you go. Prices here move constantly based on what people think will happen next. The Federal Reserve. They control short-term rates, which act as a foundation for everything else. When the Fed moves even by 0.25%, it might affect the entire economy. Market expectations. This is where psychology takes over. If investors expect 5% inflation, they won't lend money at 3%. They'd lose purchasing power. So they demand higher yields to compensate. Their collective decisions determine what yields they demand at any given moment. So interest rates are a real-time result of global investors pricing in risk, inflation, and future economic conditions. That's why a single Fed comment can move your mortgage rate overnight. Every second bond investors are asking themselves, will the Fed raise rates? Is inflation coming? Is the economy about to crash? Based on their guesses, they decide what interest rate they want. So interest rates are just millions of investors making educated guesses about tomorrow and betting everything on being right. You're still following me, right? Good. Now, important thing is you know how some people live paycheck to paycheck? Well, the US government lives loan to loan. Here's the insane part. They don't just borrow money for 30 years like your mortgage. A massive chunk of America's $34 trillion debt expires every few months. 6 months, 12 months, 18 months tops. What does this mean? Every few months, the government has to find new lenders to pay off the old lenders. It's like your credit card bill is due every 90 days, and you can only pay it by getting a new credit card. That means the government constantly has to roll over its debt, basically borrowing new money to pay back old debt. Picture this. In 2021, the government was borrowing money at basically 0% interest. Free money, right? But now, interest rates are almost 5%. So when those old cheap loans expire, they have to replace them with expensive new loans. We're talking about rolling over trillions of dollars at 5 times the cost. Do the math. The US now pays over $1 trillion per year just on interest. That's more than the entire military budget. Just on interest. So if bonds are paying 5% guaranteed, why would anyone risk stocks hoping for 6 to 7%? That extra 1 to 2% you need to justify stock market risk is called the equity risk premium. When bond yields rise to 5%, stocks need to offer even higher potential returns to compete. But here's the problem. Most stocks can't suddenly generate higher returns just because bonds got more attractive. So instead, stock prices fall until their potential yields look competitive again. That's why Wall Street panics over bond yields moving just a few decimal points. Want to see how worried investors really are? Then let's see the real-time fear index by looking at corporate bond spreads. When Apple wants to borrow money, investors barely charge them more than the government rate. They're rock solid. But when a risky startup needs cash, investors demand way higher interest to compensate for the risk. The gap between corporate bonds and government bonds is called the spread. Small spread? Market feels confident about companies paying back debt. Wide spread? Market is nervous and wants extra compensation for risk. When you see spreads widening across the board, it means investors are getting more cautious about lending to companies in general. That's usually your first sign that economic trouble might be brewing. Here's the weirdest thing in finance: the yield curve. Normally, longer-term bonds pay more than short-term ones. Makes sense. You should get paid more to lock up money for 10 years versus 6 months. But sometimes this flips. Short-term bonds actually pay more than long-term ones. This is called an inverted yield curve. It happens when investors believe the economy will weaken in the future, so they start moving their money into long-term bonds for safety. This increased demand for long-term bonds drives their prices up and their yields down. At the same time, fewer people want short-term bonds, so their yields rise. That's how short-term yields end up higher than long-term ones, signaling fear of a future recession. Here's the scary part. An inverted yield curve has predicted most recessions for the past 50 years. So when you hear the yield curve just inverted, that's a siren going off. You just learned what billionaires pay analysts millions to understand. So the next time you hear bond yields are rising on the news, you won't tune out like everyone else. You'll know exactly why your world is about to change. Understanding bonds isn't optional anymore. It is a necessity. Bonds might sound boring, but they're the ultimate boss of the financial world. And now you know their secrets. Don't forget to like and subscribe, and be sure to check out our other videos.